Hi everyone, in this episode of IFRS 15, we'll be discussing another important principle, that is the input method or output method. The full official name is input or output method for determining the transaction price. So let's get started. To make it easy for us to understand this principle, let's set up our stage here. On the right side, we have Vicky and her team at the bakery, who are selling cookies to customers. And over here we have Tom, who is their customer. Now let's try to make a sale here. So Vicky says, "Hey Tom, how many cookies do you want to buy?" And Tom replies, "I want to buy 1 cookie." Now Vicky goes over to the cash register, gets the cookie from there, hands it over to Tom and says, "Here is your cookie. It's going to cost you $1. So Tom gives her the money and says, "Thanks." Now, if you notice here, Vicky had to get the cookie from the shelf and give it to Tom. She had to go and pick something up and give it to Tom after he made the purchase. This is called the input method of delivering goods or providing services. That is what we are talking about in this principle. Let me ask you a question. How much revenue should the company recognize in this case? Should it be $1 because they got the cookie from the shelf and gave it to Tom? Or should it be the amount that they actually charged Tom, which was $2? Which one is correct? Well, this is what the companies need to decide based on this principle. Now let's take a look at the standard and see what it says. As per paragraph 74 of IFRS 15, an entity may choose to measure the transaction price using either an input method or an output method. Input methods measure the cost of satisfying a customer's order and add a profit margin. An output method measures the amount charged to the customer for providing the good or service. So what does that mean? Let's look at these two methods. First, the input method. We already saw this example of the input method earlier in the video when Vicky picked up the cookie from the shelf and gave it to Tom. Under this method, the company needs to figure out how much cost did they incur in satisfying the customer's order. In other words, how much did it cost them to make this cookie? Let's say it cost them $1 to make the cookie, and then they need to add a profit margin on top of it. For example, let's say their profit margin is 50%. That means they will add half $1 to the cost of the cookie, which is $1, and that will give them a total amount of 1 plus 0.50, which is $1.50. So under the input method, the company can recognize $1.50 as revenue. What about the output method? Let's look at this example. After Tom says he wants to buy 1 cookie, instead of going to the shelf, Vicky goes up to Tom and asks him, "Do you want a chocolate chip cookie or a peanut butter cookie?" And Tom says, "I want a chocolate chip cookie." Then she goes to the register, types in $2, and says, "It's going to cost you $2. Tom says, "Okay," and pays her the money. He takes the cookie and leaves. So in this example, Vicky never went to the shelf to pick up the cookie, but she still knows that the price of the cookie is $2. In this case, the output method is used. As per the definition of the output method, the company will use the amount that it has charged the customer, which is $2, as the amount of revenue to recognize. Okay. So now you know what is the difference between these two methods. But let me ask you this question. When should a company use the input method and when should it use the output method? What are the guidelines provided by the standard? Let's take a look. As per paragraph 75 of IFRS 15, an entity may choose to apply an input method to all transactions with a customer in a particular class or to some transactions and not others. Similarly, An entity may choose to apply an output method to all transactions with a customer in a particular class or to some transactions and not others. If an entity applies an input method to all transactions with a customer in a particular class or to some transactions and not others, it must disclose that fact. So what does that mean? Let's break this down. First sentence. An entity may choose to apply an input method to all transactions with a customer in a particular class or to some transactions and not others. What this means is that the company can choose to apply the input method to all cookies sold. For example, that means regardless of whether it's a chocolate chip cookie or a peanut butter cookie, the company will use the same method. Or they can choose to use the input method only to a specific type of cookie, for example, only to peanut butter cookies. And in this case, if a customer buys a chocolate chip cookie, they will use the output method. They don't have to use the same method for both types of cookies. They can choose to use different methods for different types of cookies. Same thing applies to the second sentence of this paragraph. An entity may choose to apply an output method to all transactions with a customer in a particular class or to some transactions and not others. Here also the company can decide to use the output method for all cookies sold, or they can decide to use the output method for some cookies like chocolate chip cookies and use the input method for peanut butter cookies. And finally, the last part of this paragraph says, if an entity applies an input method to all transactions with a customer in a particular class or to some transactions and not others, it must disclose that fact. So if the company chooses to use the input method, they don't have to use the same method for all types of transactions, but they need to disclose that fact somewhere in the financial statements. Now let me give you a real-life example of how this principle works. Let's take a look at Apple's balance sheet and income statement. Over here on the left side you can see that Apple has reported $43 million as the total revenue. Now, if you scroll down on the right side, you will find a note that reads, in applying the relevant accounting policies described above, the company elects to use an input method for software license agreements, where the amount to be received from customers is determined based on expected costs to fulfill variable consideration, such as installation and training costs. So what does this note tell us? This tells us that Apple uses the input method to determine the amount of revenue to recognize from its software license agreements. That means Apple will take into account the cost of installing and training software for its customers and add a profit margin on top of it to determine the amount of revenue to recognize. Now, why would Apple choose to use the input method here? One of the reasons could be that the cost of installing and training software is very significant. For example, if the cost of installation and training is $10,000, and Apple adds a profit margin of 50% on top of it, that will give them an amount of $15,000 to recognize as revenue. But if they were to use the output method, they would only recognize $10,000 as revenue. So that's one of the reasons why Apple might choose to use the input method. Now, what does IFRS 15 say about using the input method in this scenario? Paragraph 76 says when an entity uses an input method that includes variable considerations such as fulfillment costs, the amount of the transaction price allocated to satisfying the customer's right to payment for goods or services that are not yet delivered or performed, must be adjusted when actual costs differ from those estimates. In other words, when Apple makes the software license agreement, it will estimate the cost of installing and training software, and include that in the amount of revenue to recognize. However, once Apple installs and trains the software, it will compare the actual cost incurred with the estimated amount. If the actual cost is less than the estimated amount, Apple will increase the revenue recognized to the actual amount of cost incurred. But if the actual cost is more than the estimated amount, Apple will decrease the revenue recognized to the actual amount of cost incurred. This concludes our discussion on the input or output method. If you like this video, make sure to hit the like button. And if you haven't subscribed yet, make sure to do that so you don't miss any new videos. Thanks for watching.